Ladies and gentlemen, good day and welcome to the Q3FY25 earnings call of MPS Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star, then 0 on your touchtone phone. Please note, this conference is being recorded. I now hand the conference over to Mr. Rahul Arora, Chairman and CEO. Thank you and over to you, sir.
Thanks, Steve. Good evening from Singapore and a warm welcome to our Q3FY25 earnings call. Today on the call I have with me Prarthana Agarwal, CFO of MPS Limited, David Goodman, Managing Director, MPS North America, Archana Jayaraj, Chief Operating Officer, MPS Interactive and MPS Europa, Naren Kumar, CTO, MPS Limited, Tony Al, Senior Vice President and Head of Product Management at Highwire. Prarthana joins us from our corporate office in Noida, David from Austin, Texas, Archana from Dallas, Texas, Naren from Bengaluru, and Tony from the greater Boston area. This global representation underscores our commitment to serving our diverse stakeholders across the world. Prarthana will kick things off in our opening segment today by discussing our financial performance. Then David will update us on content solutions developments with an emphasis on the education business. Archana will discuss the rapid transformation in our e-learning business. And next, Naren and Tony will then follow up on the impressive progress made at MPS Labs and our platform business. Finally, I will provide an update on the outcome of our board meeting held earlier today before opening the call to questions. Let's get going. Over to you, Prarthana.
Thanks, Rahul. Q3FY25 delivered a strong start to the second half of the FY. We recorded revenues of INR 185.52 crores on an FX-adjusted basis, representing 38.19% year-on-year growth. EBITDA margins improved to 32.38% in Q3FY25 and overall EBITDA grew by 35.17% in Q3FY25 compared to the same period last year. Reflecting on the quarter, I would like to highlight 3 strategic achievements. Our top 15 customers now contribute to 58% of our revenue, a much lower customer concentration than when we started this journey in 2012. In line with our strategic interest, the geographical diversity of the business is also improving. For example, North America is now 45% of our revenue, while rest of the world, which is majorly APAC, is now 30% of our revenue. Revenue quality is improving, with platforms responsible for 28.56% of the consolidated revenue. I want to hand it over to David to discuss the developments in our content solutions business.
Thank you, Prarthana. Revenue in the content solutions business grew by 38.7% in Q3 FY25 compared to the same period last year. That growth was driven by the acquisition of AJE, continued expansion of the journals business, and strong upward momentum in the global education business. I joined a little over a year ago to lead the U.S. operations of MPS, and 2 main factors have contributed to the revival of the education business: operational efficiency and strategic business development. We took purposeful intent to our diverse teams across the U.S., Dune, Chennai, and Noida offices in alignment to create a global education practice. This led to numerous cost efficiencies as the U.S. team took better advantage of the opportunities we have offshore. Additionally, some strategic cost reductions were needed to bring the investment in the U.S. down to a sustainable level to match the actual requirements of the business. From a business development standpoint, the team built above its foundational structure and best practices were set as table stakes. We sponsored premier education events, implemented stronger marketing and branding, took a more strategic and governed approach with star accounts, and modernized our go-to-market strategy and approach. All these efforts led to substantial growth in our pipeline and an improved win-loss ratio. We also just signed a 3-year minimum volume agreement with a key client, which will serve as a model for other accounts. To sustain this momentum, we must continue to perform the maximum amount of work possible offshore to maintain our margin targets and allow for investment in strategic initiatives. Growth will come from star accounts. We will also continue our efforts to build the pipeline with new opportunities through more rigor in executing our marketing strategy. I would like to now hand it over to Archana to discuss the impressive progress made in our e-learning business.
Thanks, David. I'm pleased to report meaningful improvement in the margin profile of the e-learning business. EBITDA margins in the e-learning business scaled to 32.63% in the quarter. In the India entity, MPS Interactive Systems, revenues were ahead of our internal estimates and EBITDA margin crossed 28% in the quarter. And while the business is still not back to previous levels, it is reassuring to note that we are ahead of our turnaround schedule and have achieved our profitability goals. The main drivers of margin expansion in e-learning include strategic right-sizing efforts, optimizing resource allocation, and gravitating towards a more flexible delivery model using outsourcing and gig workers. Operational efficiency improvements such as enhancing billable utilization, addressing project overruns, and improving yield rates with customers have contributed to cost optimization and margin growth. A key focus has also been on reducing the overall cost per resource while increasing revenue per resource through smarter people allocation or deployment and productivity enhancements to ensure cost efficiency without compromising quality. Additionally, we are actively exploring avenues to further enhance margins by increasing the order book and expanding our revenue base. These efforts will not only allow us to better leverage resources, but also scale operations effectively. Through continued operational improvements, scalability of our flexible workforce model, AI-enabled workflows, and sustained revenue growth, these margins in the e-learning business are here to stay. Looking ahead, our focus will continue on customer satisfaction, CSAT, and diversifying our customer base, ensuring resilience and long-term value creation. I would like to now hand it over to Naren to discuss all things related to MPS Labs.
Thanks, Archana. To level set, MPS Labs is a state-of-the-art tech innovation lab having an experienced expert practice group with deep exposure to the research and learning domain and new age technologies revolutionizing the education industry. With a 250-plus member team, MPS Labs focuses on research and development efforts, studying market requirements, challenges, trends, designing, developing, and introducing innovative solutions that introduce efficacy in the end-to-end content lifecycle. This strategic approach combines leveraging on, let's say, AML, NLP-driven solutions and cloud-based SaaS solutions with the development of proprietary tools, workflow automation, intelligent analytics, and streamlined editorial processes. MPS Labs has been working on various use cases in AI/ML across workflows and has recently implemented AI/ML-based automation for processes like content structuring, content editing using AJ's query platform, accessibility, image processing, and chatbots. Our most recent achievement has come in partnership with Highwire, the platforms division of MPS. Together, we have developed and rolled out the next generation end-to-end publishing workflow solution that consolidates both the pre-acceptance and the post-acceptance into one single workflow, thereby reducing inefficiencies and increasing the speed of delivery. I would now like to hand it over to Tony to discuss the developments in the platform business branded as Highwire.
Thank you, Naren. As a result of the acquisition of AJE, the platform business grew by 88.9% in revenue in Q3 FY25 compared to the same period last year. Additionally, Highwire's visibility in the market has improved through thought leadership activities, participation in industry groups, and organizing workshops and webinars. This has led to an increase in FRIs, RFPs, and client renewals. Notably, as Naren mentioned, Highwire has launched DigiCore Pro, a next-generation publishing platform based on the principles of single-source publishing. This methodology centers on scholarly content, reducing inefficiencies, and accelerating research delivery. DCP's modular architecture and APIs support microservice integrations from MPS Labs and third-party partners. Current clients are transitioning to DCP, and over a dozen prospective clients are testing the platform. We expect to have clients using the full end-to-end submission to publication workflow in 2025. I would now like to hand it back over to Rahul to conclude this opening section.
Thank you, Tony, and thank you for the comprehensive update, team. scaling and digitally executing our well thought through and tested installed growth strategy continues to deliver strong business results. Our 5-pronged approach has powered the recent momentum, which includes a revised go-to-market strategy, a stronger emphasis on cross-selling and upselling in star accounts, the addition of new customers across business segments, the launch of new capabilities such as AI-powered DigiCore Pro, and an unprecedented pace of integration of AJE into MPS. Now to go over to board outcomes. I am pleased to share that based on the robust earnings growth in the first 9 months of FY25, the Board of Directors has declared an interim dividend of INR 33 rupees per equity share of INR 10 each of the company. On capital allocation, our priority is always to redistribute surplus funds to the shareholders of MPS, provided there is no imminent use of those funds over the next 6 to 12 months. This approach allows us to stay focused, disciplined, and responsible. We believe that even after this distribution, MPS will have adequate funds for upcoming acquisitions. Our acquisition approach is now focused on acquiring healthy and growing assets, albeit at compelling valuations, and significantly enhancing shareholder value. Let's now open the call to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Arun Maruti from Shubhlal Research. Please go ahead.
Hello, am I audible?
Yes, you are.
Yeah. First of all, sir, congratulations for the stellar performance. Very excellent result. Sir, my question is with regard to the e-learning segment. That in e-learning vertical, we have shown Q-on-Q revenue is almost constant, but despite that, we have encountered a very exceptional growth in the margins. I would like to know the rationale behind this exceptional performance, and is it sustainable going ahead?
Sure. I'll take a quick stab at it, and I'll request Archana to come in and describe what has really happened here. So firstly, thank you for your kind comments on the results. The e-learning business has been going, specifically the India entity, which is the largest part of the e-learning business, has been going through a transformation after the acquisition of Liberate. After we majorly acquired Liberate last year, we understood, that there is a potential to scale margins in an e-learning business as well through a flexible operating model, and we've brought that model to the other entities within e-learning as well, and that's largely been the result of the margin expansion. But I'll let Archana expand on that.
Thank you, Rahul. So as explained earlier, the margin expansion in e-learning was the outcome of a few initiatives we took, like gravitating towards a more flexible delivery model where we use outsourcing and gig workers more. And we also had strategic right-sizing efforts and the optimized resource allocation overall. So there was a key focus in terms of reducing the cost per resource overall while increasing revenue per resource through smarter people allocation and deployment into projects. And these enhancements led to cost efficiency without compromising any quality.
Okay, so I can guess that there was a good amount of churning in this e-learning segment in the employee side. Am I correct?
Could you please elaborate on churn?
So as you mentioned that you did the right sizing and the right allocation. So because as the employee count is more or less same of the last quarter and this quarter also, so whether there was a good amount of churning and a good amount of recruitment, or am I going somewhere wrong?
The focus has been in terms of allocating people to projects depending on the cost per resource, and this has led to an optimization because we have reassigned people to projects depending on the yield rates of these projects. So our focus has been on increasing the billable utilization of the resources that we have, increasing the outsourcing efforts, and also addressing project overruns, keeping it to a minimum, and improving the yield rates with customers. So all of these put together have created a compounding effect in terms of enhancing margin.
Thank you. The next question is from the line of Rahul from Dolat Capital. Please go ahead.
Yeah, hi. Hope my...
Hello.
Yes, Mr. Rahul, your line has been unmuted. Please go ahead with your question.
Yeah, so first of all, congrats on good performance. And the question was related to the David's comment on, how he's seeing cost optimization deal as one of the trend driving the momentum in the content side. And there was a mention of a 3-year volume locking, something like that. I could not get the nature of it. So any comment on that, how the pricing gets impacted instead of volume committed deals, and how in general the cost optimization trend can possibly drive the growth momentum. Any color on that would be helpful. Thank you.
Yeah, so I can take that. So any cost whenever we do these long-term deals, these are not just brute arrangements. Typically, there's a very clear path of where the efficiency will come from. So we have proposed the utilization of proprietary technology and optimization of workflows as we propose this in this 3-year arrangement. And yes, the customer does get year-on-year cost improvement, but we also have linked it to spend increase. So our revenue is going up, and our margins will only improve as the revenue goes up. So it is an exchange. It is kind of a value trade where we are improving the throughput of the system, and as we do that, we are passing on some of the efficiencies to the customer, and we are also gaining because we're pushing more through that system. So that's on the specific 3-year deal. On the in terms of cost optimization, as David pointed out, that there's been two levers here. One is, of course, just reducing the overhead cost in the US in general. The second has been looking at new areas of offshoring where we traditionally have not offshored, and that's led to margin expansion as the revenue has grown.
Got it. And any flavor, Rahul, you could give on how things are shaping up on the AG integration side? Is it trending on the revenue side the way we were planning, and also on the profitability? If you could share a number or at least directional thoughts.
Yeah, so the focus for AJE, has really been around improving margins quarter on quarter, which we have improved. We're now trending in the late 20s in terms of EBITDA margin. Those margins will continue to improve. In terms of growth, really the revenue has been stable. The part of the business that has started to grow has been more on the B2B side. That's the part of the business that's starting to grow now that the business is settling down.
Right. Sorry, I missed the number you said. How much EBIT margin you said?
In the late 20s.
Late 20s. Okay. And revenue run rate is in that 225 odd crore, similar to what at the time of integration, or it's downsized or grown from that point?
It's fairly similar. I don't want to reveal too much specifics because this is a new market. We are one of the big 3, one of the big 4. And I'm told we are very actively tracked given that we are a listed entity. So still learning the ropes when it comes to this particular market.
Right. Just last one from my side. Any update on the managed training side of the business? How things are shaping up there? What we see generally in that market is that it's slightly opening up on the resumption of training side. So if any progress on those front could be of help. Thank you.
The e-learning business continues to grow. Having said that, we have not gotten too many new orders around managed training. It's pretty similar to what we reported last quarter.
Understood. Thank you, and I'll jump back.
Thank you. The next question is from the line of Guneet Singh from Counter Cyclical PMS. Please go ahead.
Hi, sir. You have done a great job in improving the operating margins from Q1, about early 20% to 32% this quarter. So, sir, I would like to understand, is there some scope of further improvement in margins, and what are the expected steady-state operating margins that we are targeting, and by when can we achieve that? This is my first question. And my second question would be regarding, so, sir, you generally give certain guidance about the future outcomes. So would you like to provide some guidance in terms of what kind of growth we can expect in FY26, and how much of that would be organic, and what kind of inorganic opportunities we are targeting? These would be two of my questions.
Yeah, on the margin front, we are pretty happy with where we are right now. That we could see additional appreciation, because historically our lens on e-learning has been 25% type of margin, and as you can see, we've crossed that 30% hurdle that we've been trying to cross now for 2 or 3 years for the first time. So our goal really is now, and I'm specifically focusing on e-learning because that traditionally has been kind of the lower margin business. Now that business has crossed 30%, I think our first goal is to make sure we keep repeating this level of margin and profitability. And of course, as revenue grows, given the operating leverage in the business, margins will continue to grow. So at this point, we will really look at revenue growth to drive margin expansion, and that's really the thinking. Have we maximized the operating leverage? Absolutely no. That still, as revenue grows, margins do expand. So that will continue to happen. In terms of guidance, we took a call last quarter that we have a very good North Star in Vision 2027, which is 1,500 crores in revenue at similar margins by FY28. We feel comfortable as a management team that North Star is something that we like to move toward, and we no longer wish to provide any quarterly or short-term guidance because we feel it's more a distraction from that North Star. I had shared that in the last quarter as well. So we will, going forward, abstain from any short-term guidance because we feel it is a distraction and does not add any value to the business. In terms of acquisitions, we are essentially looking more at education plays, given that the last few plays have been across corporate and research. So we are specifically looking at more education plays, given that our last acquisition in the education world will go back in 2015. So education is really the focus. Within education, we're looking at some adjacent markets where there are plays where we are getting closer to the end consumer, as well as looking at platform plays. So we are not looking to do more of the same within education. We're looking to diversify both in terms of capabilities, but as well as geography.
All right, so thank you very much. I got it. I'll join the queue back.
Thank you.
Thank you. The next question is from the line of Mahesh, an individual investor. Please go ahead.
Hi, Rahul, can you hear me?
Yes, I can.
Rahul, a few questions on e-learning. What is the update on the 15 new logos that you won in Q2 FY25?
Sure, thank you. So the 15 logos we had won was in the first half, not Q2, but that was a good observation. I'd let Archana, who runs that business, talk a little bit about how those 15 logos are progressing.
Thank you, Rahul. So we have completed some of the projects and are in the process of delivering other pilot projects with the new logos. And I'm happy to report that the feedback so far has been encouraging, and we are optimistic about the long-term potential with these new accounts.
Okay. The second question on e-learning, Rahul. What are your thoughts on acquiring firms with AI capabilities in e-learning specifically?
So, the way we look at AI specifically is, more around operational efficiency or, so far that's really been the focus. We do have some AI-based revenue streams now as well. So there aren't too many scaled players that we have been able to evaluate of what you described. What we've seen so far are opportunities that are sub 5 million in revenue, and as a result, we have not so far looked at those type of opportunities because they're subscale opportunities. Having said that, if something does come our way that's more scaled, we will, obviously look at those kind of opportunities as well.
Just one follow-up question now that you mentioned using AI as revenue stream. Can you describe the kind of progress you have made on that?
Yes, sure. So we, as I had pointed out in a previous discussion, we historically were doing more small consulting projects, less than $50,000 per project. We were doing, POCs for virtual reality. In the last, couple of quarters, specifically in the education business, we've been able to win some large contracts within translation, AI-powered translation. We've won contracts over 3 million. Similarly, on the accessibility side, we've won contracts over 1.5 million that are AI-enabled, projects. Additionally, we've done some software development upwards of $250,000 as well. So the AI work stream is now, the revenue stream rather is becoming a reality for MPS. So I would say overall, it's still sub 5 million, but getting closer to 5 now.
Okay. Thank you. I'll come back in the queue for more questions.
Thank you.
The next question is from the line of Karan Kaporia, an individual investor. Please go ahead.
Am I audible?
Yes, sir.
I have two questions. I want to check first thing about the next acquisition planning. So do you think there will be a requirement of any debt for our internal activities? Internal cash will be enough?
Thank you for your question. As I was sharing, the next set of acquisition plays are mostly going to be in the education space. We can't really provide any forward guidance on what those are. What I can share is, if we do have to take on debt, we're comfortable taking on 150 crores. But at this point in time, we don't have such a requirement.
Understood. I want to check one more question. So in the last con call, so Tony mentioned about there is a risk of security of copyrights and data privacy of our customers, right? While we embrace artificial intelligence and ML. So how do we see that kind of risk coming? And can you elaborate on that to get more insights into that?
Tony, you want to take that? Is there some risk linked to data privacy and customer data with AI?
Yeah, sure, Rahul. Yeah, so in terms of, definitely yes, there are client concerns on this area as well. So We take a lot of precautions on this, and we do have, we are ISMS certified, and, in terms of data privacy, we ensure that all adequate safeguards and protocols are followed while we implement and develop the AI-based solutions within our platforms and workflows. So, for example, we try to ensure that we don't use any customers' content in the AI models without their permissions. And all our AI-based models are privately hosted and only exposed to us. So we don't expose anything outside on the internet.
Thanks.
Does that answer your question, Mr. Karan?
Yes, thanks.
The next question is from the line of Pratik Kulkarni from Kamyaka Wealth Management. Please go ahead.
Hello, sir. Good evening. One set of players. Congratulations on that.
I'm sorry to interrupt, Mr. Pratik. Your voice is coming very low.
Hello.
Please
is
use
it
your
working?
handset.
Just a second. Hello, is the audio okay now?
Yeah, sir. Please go ahead.
Yeah, so I just wanted to know that, last year we were saying that the market is quite fragmented, and currently, there is consolidation phase going on where MPS is also, playing a role of the consolidator. So just wanted to know the outlook on the market and how is it currently?
Yeah, so all the markets that we operate in, three core markets: research, education, and corporate. All three markets are quite fragmented. There is consolidation, as you rightly pointed out, going across all three markets in different ways. Within research, we have customers entering the supply chain side. We have competitors buying each other out. On the education side, there are multiple private equity exits happening. On the corporate side as well, there are exits happening. So, the market keeps consolidating and is growing. So overall, education is growing at 13-14%. Corporate is growing at 11-12%. Research is growing at about 8%. So yeah, it's pretty much same commentary from last time in terms of the market and how it's progressing.
Yes. Okay, thanks. And one more question is that if the market is, like you said, is quite fragmented, so how are we able to, maintain such good margins, and do we have some pricing power regarding to that?
So a couple of things. I think one, our value proposition in terms of corporate strategy is really around operational excellence. We drive operational excellence through smarter workflows. We tend to throw technology at the problem rather than throwing people at the problem. So we're constantly looking, MPS Labs and Narain's teams are constantly looking to automate tasks and also reduce the number of touch points in any workflow. Thirdly, we tend to, our teams tend to be present more in tier 2 and tier 3 cities, which also, and that's not just in India, that's across the globe, that also allows us, an additional competitive advantage. So typically, we tend to do things, in a more process and technology-driven way in a world where most people are throwing people at the problem, and that's really what is different about MPS is, our level of operational excellence. If you look at the organization, while the employee costs have gone up over the last 13, 14 years, when ADI had acquired MPS back in 2012, we had 3,500 employees and our revenue was about 120 crores. Today, our revenue is 6-7 times of that, and we have less employees, 3,000 employees. So that just shows the level of efficiency that we're unlocking through the various methods I described.
Okay, sir. Thank you so much.
The next question is from the line of Krushi Parekh from Bugle Rock. Please go ahead.
Yeah, hi, can you hear me?
Yes.
Hello?
Yes, sir, we can hear you.
Yeah, hi. So, my question is that we have been talking about the growth available in the industry, and we just also mentioned about the corporate sector and all growing at about 10-12% and all. But when we look at our e-learning segment, for last 10 quarters, it has stagnated at about 34, 35 odd crores. So, is it like the revenue has undergone certain structural changes within over this period? And is the cost optimization period over for us now, and can we look for revenue growth here onwards more versus cost optimization?
Yes, sir, I'll quickly address that, and then if Archana, you want to add anything, feel free to. So, overall, having turned around businesses over the last 10-12 years, one of the things our management team has learned is that you can either chase margin expansion, especially when you're doing a turnaround, or you can chase organic growth. Typically, if you tend to chase both, you don't achieve either. And really, one of the big asks that we've had of the e-learning team is to get e-learning, or rather corporate learning, over the 30% margin, because that's the average margin of the total company. Now we've achieved that. The goal will be to repeat that in Q4 and really take off from FY26 in terms of organic growth. We felt that we needed to be fit first before we could run faster. But Archana, feel free to add more on the organic growth side.
Thank you, Rahul. So, as discussed, the focus was primarily on improving the health of the business and strengthening our fundamentals from an ops efficiency standpoint. But having said that, we will continue to focus on new logo acquisition and also enhancing business with the existing accounts that we have. So this will, in fact, the focus in this area is the logical next step for us. Now that we have achieved stability from an ops standpoint, the logical next step will be the growth and expansion.
Okay, got it. So FY26 onwards, we are likely to focus on the growth, and we are done with our cost optimization phase. Is what if I can summarize that.
Correct.
Okay.
Absolutely.
Also, just one more suggestion, if it may be possible. So we have this target of 1,500 crores by FY27, the ambition. What I recollect is that about 60% of that will be organic growth, 40% will to inorganic. Present, if we can also get a split between the organic and inorganic growth as well.
Yeah, thank you for that observation and suggestion. Please also realize that you're a well-wisher. Please also realize that we are in a highly competitive market, and we are one of the few listed players. So our competitors are tracking us, and some of this information is counterproductive. So for that reason, that's one of the reasons why we have not shared many of the cuts that have been sought in the call today, because it's a competitive market and we really focus on growing the business. Yeah.
Okay, got it. And just one simple question. Is the so we are now also working with the gig workers. The expenditure of that will not be part of your employee expenditure, right? Or it will be, is it housed under some another expenses?
It's under outsourcing. So, Pratna, you could correct me which line item is outsourcing in on the income statement.
So, if you look at the financial statement, it comes under other expenses. It's outsourcing cost, but other expenses. It's subcategory of the other expenses.
Yes. Thanks, Pratna.
Thank you. The next question is from the line of Naveed Virani from Bastion Research. Please go ahead.
Hello. Thank you for the opportunity, and congratulations on the incredible amalgamation of AG and its turnaround. So I have a few questions. First one is on the geographic mix. So now that the rest of the world part has become a major chunk of the business, can you share a more nuanced view about what is the kind of work which we are doing there? What is the kind of customer profile? Which are the regions? I understand it's APAC, but which are the regions under APAC which are driving growth? If you can share a more nuanced view on the rest of the world business, it would be helpful, sir.
Sure. I think just before I do that, I think the overall commentary that we have, MPS as an organization, we're very bullish on APAC, and I personally have relocated to Singapore earlier this month because that's how serious we are about the play. As you know, previously I was based out of the US. For us, the biggest markets within APAC really today are China and Australia. Those are the two big markets. India is also an important market for us, but currently it's fairly small. Currently our biggest markets are China and Australia within APAC. Within China, our focus today is mostly on working with researchers in helping them get published and recognized by the Western world, which includes not just improvement of language, but improvement in terms of how they submit the papers to an organization for it to get published. It also includes some technology that we license to this customer base. We also work with funding bodies and universities as they're looking to advance research in the region. Within Australia, the play is more around e-learning, both for corporates as well as for educational institutes, and that business is also rapidly growing. Within India, our play is mostly around corporate learning and more to do with more on the marketing side. But we are also actively looking to scale the researcher business within India through our Q3 platform, which we are rebranding as Rubric. So currently the plays really are China, Australia, India, but we are looking at this region very strategically. South Korea and Japan are two markets that we want to enter. We know our competitors have enjoyed very good market share for the past decade or so, and we want to challenge that market share going forward.
Perfect. Thank you for that elaborate answer. Next up, I want to understand more on platforms. So, in my understanding, platform is a very strong business, both from a recurring nature of a revenue point of view as well as a very strong profitability point of view. So, what I want you to share is what is the growth plan for platforms going forward? If you can give some more information there.
Yeah, I would say I think there are three types of plays that we have within the platform business. The first play is what Lorraine and Tony described at the top of the call, which is launch of the next generation of a workflow solution that essentially unifies a broken workflow which ideally should have never been broken, and basically improves the throughput of that system. So that's called DigiCo Pro. As Tony was describing, we have current customers who want to migrate, and we have a dozen customers that are currently playing around in a sandbox environment of that platform. So that's one big play. Our competitors are north of 50 million in revenue in this type of product alone. Our revenue is much lower. So this is one play that we're very, very bullish about, and we are now in active discussions with many customers of how we can transition them in. The second big play for us is advancing the Q3 platform. The way Q3 came to us was an AI writing assistant. We are now pushing the boundaries of Q3 to not just be a writing assistant, but kind of be a companion to a researcher who is attempting to get published in a reputed journal. This companion tool will improve the language, will improve the probability of the researcher getting published, but also recommend to the researcher where they should submit their articles so that they can actually get published. And once they accept, and also help them manage that journey from submission to acceptance. So basically advancing query into the world of getting published. So those are kind of the two plays that we're looking at from the scholarly side. The third play is more around on the education side, where we are trying to basically reconfigure a lot of the technology that we have through Highwire and other acquisitions, and we're trying to reconfigure that for the education marketplace. That particular initiative is still under the works and is going to be launched later this year. So I don't want to undercut that go-to-market plan. So we'll share that update with you when the time comes. But essentially, we're looking at an opportunity to expand the market through entering a new category, but also taking some of the existing capabilities and opening them into adjacent markets.
Thank you. The next question is from the line of Rav Naredi from Naredi Investments. Please go ahead.
Rahul, you and your team are doing well since last few quarters, and we wish all the best to you and your team. My point is, so which country you find no new business as our rest of the world business rises 27%?
Sorry, I didn't understand the question. Could you repeat that, please?
Sir, which countries you find now one for business is our rest of the world percentage rise 27% versus 8% last year?
Yeah, so like I was explaining earlier, it's mostly China and Australia.
China and Australia. Second, head count are interchangeable, means content to platform to learning, e-learning and vice versa?
Not like to like. There's some fungibility between content and e-learning and within platform solutions and MPS labs, but yeah, it's not like to like. It's not that straightforward.
Thank you. The next question is from the line of Madhur Rathi from Counter Cyclical Investments. Please go ahead.
Sir, I'm trying to understand that in our platform solution division, there has been a degrowth in the PBIT quarter on quarter from 20.30 to 17.9 crores. So is this a blip or is this a trend? And sir, going forward, what is the expectation from this division?
Is your question around margin contraction in platforms?
Yes.
Yeah, that's entirely on the account of AJE, and of course that will continue to improve. So standalone, the margins have in fact improved. The erosion is entirely because of AJE, and that will improve every quarter.
Sir, and like you mentioned that last year that there are the more cost efficiencies on the AJE side. So have all of them been realized in the third quarter, or is there still more to go?
Still more to go. We haven't realized all of it yet.
So thank you very much. And sir, any light you want to shed on the inorganic acquisition scenario? Sir, have the valuations come down or are they going up, and what kind of opportunities are you basically evaluating? So any light on that?
Yeah, I think so. FY 2025 has been a record year in terms of the number of deals we've looked at. Valuations can go up or down. Finally, you know us. We are very disciplined. So we won't go up and down. We will stay strong. And we continue to be highly disciplined in our approach, and we're casting a wide net to make sure that we continue to be consistent in our acquisitive execution. Like I said, record-breaking year in terms of number of deals evaluated. still haven't concluded one yet. So, maybe that helps you understand the situation.
Great, sir. Thank you very much and best of luck.
Thank you.
The next question is from the line of Janish Shah from JS Equity Invest. Please go ahead.
Yes, sir. Congratulations on good set of numbers. Just a couple of questions on the acquisitions. First on acquisitions and maybe a little bit on the operation or the business environment.
Sorry to interrupt, sir. Your voice is coming muffled. Can you?
Yeah. Is it better?
Yeah, sir, better.
Yeah. So just wanted to understand on the on the acquisition side. I think last time you mentioned that I think there was a roadmap which was given with regard to how the acquisitions would be funded. So for first couple of acquisition, it was more through the internal accruals and the debt leveraging, and then thereafter you always wanted to go for an equity for a last option. Given and I think now the way the AJE is shaping up, how is the roadmap you're looking at for the acquisitions, for the future acquisitions, for funding those? How do you see the funding? Is there a change in the plan? Do you see whether it is like either going or slipping more into an equity dilution or maybe through funding through internal accruals? How do you see the situation? That is first. Second, on the operating, you are looking at, you already acquired a few of the logos, and remaining focus is more on the growth. But if you can just paint the external environment, how does it look like? Since you're not guiding, not going to guide for short-term growth numbers, just if you can give some flavor as to how do you see the operating environment given the external environment is being, that can give a little bit of an understanding on how how the company is going to navigate for next 1 year or so. Thanks.
Thank you. Yeah, I think given the type of balance sheet that we have, the high margin business and high cash flow business, from our perspective, the funding is not going to be a non-issue for us, at least the way things are situated today. So for us, it's more important to figure out what acquisition target that we actually then trigger, because as you're seeing, the size of acquisitions, the scale of acquisitions is increasing every year. AJE was, while it was not a big bite in terms of purchase price by the end of it, but from a revenue standpoint, fairly sizable bite. That purchase price was more a negotiation thing, but the bites are getting meatier. So I think the focus on our end is more to make sure that we get it right. You get it right firstly by not overpaying. That's the first fundamental. And the second fundamental is, you're buying something that you can then grow, and it's not something that declines or stays flat. So most of our focus on the acquisition side is getting that piece right. We're also looking to see if we can extend the owners who currently are running some of these organizations forward, like we've done with Rod and Liberate. That model has worked really well for us. So funding for us, the way we look at it, accruals first, debt second, if and only if there's no other option available, we get to equity. So that remains there, but I think it's just those are just principles. We're not really spending too much time on that because for us, getting it right is more important. Coming to your next question on external environment, like I said, there are three markets. There's research, there's education, there's corporate. Research is this steady state market that doesn't grow rapidly, but also doesn't decline in recessions. In this market, our opportunity is of four types. The first type is to work with the funding body and the researcher to help them get published. The second type is to consolidate the supply chain for an institution that's either a publisher or is involved in publishing in some form. The third is being a software provider. But the fourth, which is the most interesting play, is being a managed services provider that combines all these three activities. So we tend to have, within research, we tend to have three types of competitors. We are the only play in the market that has all three capabilities that I described. So we are opening up a fourth play, which is consolidation of the value chain on behalf of the customer. The second market for us is education. Here our play is slightly different, where we are looking to get closer to the end consumer, but in a end learner, but more in a B2B way. So we don't want to deviate from B2B, but we're trying to get as close as we can to the end learner, and as a result, are moving forward in the education value chain. What that is doing for us is, A, it's giving us access to larger opportunities, B, it's also giving us access to a market that's growing faster compared to the market, the education market that we were operating in previously. Within corporate, our focus is now moving towards signing global agreements, given that we are one of the few players in the market that has not just the Americas and Europe and UK covered, but we also have China, Australia, and APAC covered. That's generally not the case with most suppliers in corporate. So we're trying to get to more global type of arrangements with our customers, which some of it includes managed training, but some of it just includes global e-learning arrangements. So overall, three different markets, different types of plays, and that's really how our management teams are also structured now, where we have dedicated teams focusing on some of these plays.
Mr. Janesh, does that answer your question?
Yeah, just the last one. On the overall, the longer term guidance which you are looking at for 1,500 crore by FY28, I think the last time you indicated that the progress has been ahead of the schedule. How do you want to evaluate that? Is it still the case, or do you think it's too early to really make any changes on those timelines for the goal?
Yeah, I think we stay consistent. We made the error of sharing guidance at the beginning of the year. Having said that, we are hitting the guidance. So FY25 is going to be the halfway mark. So we hit halfway at the end of this year. We confirmed the guidance that we've already shared. In terms of what happens after FY25, like I said, it's 3 years. So it's not like we're not talking 10 years. We're talking 3 years. And for me, what's important is, for my team and I to get it right in those 3 years. Now, whether it takes 1, 2, or 3 is unimportant. What should happen is that we get it right by the end of the third year.
Thank you, Ed.
Thank you. The next question is from the line of Parimal Mithani from Credential Investments. Please go ahead.
Yeah, can you hear me?
Oh, yes, you can.
Yeah. Congratulations for a good number, Rahul. I just wanted to know, in terms of margin profile, is it going to be same at similar levels on a yearly basis, or is it going to change a lot?
Yeah, I think we're very happy with this level of margin. I think, like I was explaining on an earlier question, was there is operating leverage in the business. So if there is organic growth, margins will expand. What we tend to see is that for every 10% of organic growth, you see a margin expansion. But yeah, I think we feel comfortable that these margins are repeatable. Specifically with e-learning now going north of 30. So as long as that business continues to operate the way it's supposed to operate, we feel very comfortable at these level of margins.
Okay, thank you, and all the best. Thank you.
Thank you.
We take the last question. It's from the line of Pakul Sood from Satya Wealth. Please go ahead.
Yeah. Hi, Varun. Congratulations on a good set of numbers. So I just had one observation that if I see the results for the quarter ended and 9 months, so our revenue has outpaced the EBITDA growth. So when do we see operating leverage come in? If you could just give a view on that.
Sure. So like I can explain, when we acquired AJE, it was supposed to be a larger bite in terms of purchase price. At the very final, end of the transaction, we proposed an idea that, instead of the seller turning around the business and then giving it to us, we would save them the trouble, because they went through an IPO last year, and they obviously didn't want any bad press. So we offered to them that, whatever plans you have in terms of turning this around, we will take that pain on. But let's reduce the purchase price. And I think we came, as good partners, we came to a good solution. So Q1 for us was soft, as you'll see, and a large part of that was, all of it in fact was AJE. Even now, we do see the platform business, that business's margins getting affected by the AJE business. So, if you look at like to like, there is margin expansion. It's just that we've onboarded AJE in this financial year, which hit us in Q1 and which will continue to improve. So we're still not at the full potential of the AJE margin, which is operating currently in the late 20s.
Okay. And another thing is, what would be our cash balance after this dividend payout?
Pratna, that's a question for you.
Yeah. So the existing cash balance is around 124 crores. After the dividend payout, the same would be around 68.
And just to clarify that the cash balance that Pratna talked about was as of December 31st. We obviously every month we get 15 crores more of free cash flow.
Yeah, this was the position that was as on 31st.
And when going forward, do we see the dividend payments only, or do we also consider buybacks on our part?
So far, we've only been looking at, as a board, at dividend payment. There are discussions around all opportunities, but we don't see much value in doing anything complicated, so we've kept it simple.
Okay, great. That's all from me. Thanks, Varun.
Thank you. Ladies and gentlemen, that was the last question for today's conference call. I would now like to hand the conference over to Mr. Rahul Arora for closing comments.
Thank you for your active participation in our earnings call. We appreciate all your thoughtful questions. Your unique outside-in perspective helps us learn and improve. I want to thank all our stakeholders for their continued support in this remarkable journey. We have a tremendous opportunity ahead of us, and we look forward to your continued support, feedback, and partnership mindset as we all march towards Vision 2027. Thank you so much.
On behalf of MPS Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.